Welcome everyone to Chapter 13 Synopsis of the Intelligent Investor. Chapter 13 does a comparative analysis of 4 companies based on concepts on chapters of the book. They look at profitability, stability, growth, financial position, dividends, and the price history. First, profitability. They look at mostly price to earnings ratio, net per share per book value, net income to sales. Does the price justify the amount of income and revenue that they're getting? Next is stability. You look at the past 10 years, look at their earnings per share and see whether or not they're growing or declining, which is compared to the past 3 years. That's concept number 3. The 2 and 3 kind of tie together. Next is the 4 financial position, which is their assets compared to their liabilities. The book recommends a good company has twice as much assets compared to what they owe and their debts. Next is the dividends or the dividend yield as well. A company should have 20 plus years of dividends going back to their shareholders. That means that the company, whatever their profits they're making, they're giving it back to their shareholders who actually own the company, and they're not keeping it to themselves. And then you should have an increasing dividend yield. So a greater income goes to their shareholders as opposed to lining their own pockets. And then price history, which is looking at their price compared to the stock market in general during their boom and bust cycles to see whether it's attractive enough. And then you look at that according to their PE ratio as well to see whether or not it's a good buy. So they look at those 6 criteria and then judge a company. If they meet all 6, that's a great company to buy. But remember, you need to do your research and actually know how to calculate these numbers. It gets pretty complicated and technical, but we can do it, and I'll help you through it as we finish the book and start looking at stocks.